Hey everyone, welcome back to Corporate Decoder, the place where we sometimes uncover financial puzzles that might make even Sherlock Holmes scratch his head. Get ready for a deep dive into Rein Therapeutics Incorporated. Today we are dissecting their latest 8K filing, and let's just say there is a lot more to this current report than meets the eye. Also, if you love getting these corporate breakdowns without any fluff, make sure you are subscribed. We also have a Discord community linked in the description below where we chat about these filings all the time. So what exactly is an 8K report? Think of it as a company's way of telling the public about major events that shareholders really need to know about right away. It is not an everyday update, it is for the big stuff that can shake things up. Our company for today is Rein Therapeutics Incorporated. Now this filing dropped on the 23rd of October 2025, but it is talking about events that happened on that same day and leading up to it. They are listed on the NASDAQ capital market under the ticker symbol RNTX. The core of this filing is about a financial agreement called a Prepaid Advance Agreement, or PPA for short. In simple terms, Rein Therapeutics has made a deal with an entity called Accession Limited, which they refer to as Yorkville. This agreement allows Rein Therapeutics to get money from Yorkville in advance. It's like taking out a loan, but with a slightly different structure. This isn't brand new. They first announced this deal back in July 2025. The agreement lets Rein Therapeutics ask for up to $6.0 million over a 12-month period. But here is a key detail. Yorkville buys these prepaid advances at 95% of their face value. What does that mean for Rein Therapeutics? It means for every $1 million they want, they only receive $950,000. That is a 5% discount right off the top. This is a common way for companies that might be struggling a bit to get quick cash, but it comes at a cost. The interest rate on these outstanding advances is also pretty steep. It starts at 8% annually. But if things go wrong, meaning if there is an event of default as described in the agreement, that interest rate can balloon to a whopping 18%, and all these advances are due to be paid back essentially 12 months after they are issued. Now this is where things get really interesting and potentially concerning for existing shareholders. The agreement gives Yorkville the right to demand that Rein Therapeutics issue and sell them shares of the company's stock. These stock issuances are then used to pay off the outstanding prepaid advances, including any accrued interest. They've already done this a couple of times. On the 29th of July, they got their first advance of $1.0 million, receiving $950,000 net. Then on the 8th of September, they got another $1.0 million, again netting $950,000. But to pay back part of that first advance, Rein Therapeutics issued about 953,765 shares to Yorkville at an average price of $1.0562 per S-share. This covered over $1.0 million of the principal and interest. Then for the second advance, they issued another 927,107 shares at an average of $1.0825 per S-share, covering over $1.0 million. And on the 23rd of October, the very day of this filing, they requested and received a third $1.0 million prepaid advance, again netting $950,000. This means they are continuously drawing down on this facility, and each draw potentially leads to more shares being issued. This unregistered sale of equity securities section confirms that these shares were issued without having to go through the full registration process with the Securities and Exchange Commission. They are relying on an exemption, which means they are selling these shares directly to Yorkville. So here is the situation. Rein Therapeutics needs cash, and they are getting it through these prepaid advances from Yorkville. However, the cost is significant with that 5% immediate discount and potentially high interest rates. Even more importantly, Yorkville has the right to convert these advances into company stock. This process is called a debt for equity swap. This cycle of taking advances and then issuing stock to pay them back can be a slippery slope. For existing shareholders, each new issuance of stock dilutes their ownership percentage. If you owned 1% of the company and they issue 1 million new shares, your ownership percentage will decrease unless you also buy more shares. This can drive down the stock price because there are more shares outstanding, and it can signal to the market that the company is having trouble raising money through more traditional means. This section simply tells us that these prepaid advances are direct financial obligations for Rein Therapeutics. They are borrowing money and they have to pay it back. And finally, the exhibits listed here include the actual prepaid advance agreement itself, filed as Exhibit 10.1. This is the document detailing all the terms and conditions we've been discussing. Now, let's get to my take on all this. Rein Therapeutics is clearly in a cash crunch situation. They are using this PPA facility to keep operations going. But the terms are not favorable. Every $1 million they take means they only get $950,000, so they are starting with a loss. And the potential for significant dilution through Yorkville converting debt to equity is high. The company's strategy here is to get immediate funding, which is crucial for a company in the development stage like Rein Therapeutics, presumably working on new therapies. However, the risk is that they could end up significantly diluting their existing shareholders, and possibly even losing control if this debt keeps growing and being converted to stock. The opportunity for Rein Therapeutics is that this agreement provides a lifeline. It allows them to continue their work and hopefully reach milestones that will allow them to raise capital on better terms in the future or generate revenue. The risk is that they get trapped in a cycle of debt and dilution. Looking at the numbers we see here, the repeated drawdowns of $1.0 million and the subsequent share issuances suggest a consistent need for capital. The average share price for these conversions is around $1.07, which is quite low. This indicates that the market valuation of the company at the time of these conversions was not very high. So, what is the verdict? Rein Therapeutics has secured a necessary funding source, but it is a double-edged sword. They are betting that they can use this cash to achieve their goals before the dilution becomes too severe. The next few months will be critical to watch how they manage this agreement, and whether they find more sustainable ways to fund their operations. Alright, that is our breakdown of Rein Therapeutics Incorporated's latest filing. What is your take on these financing decisions and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.